Hi folks, Lee Gettess here with the Market Sense for the week of April 24th, 2018. The charts in this presentation are provided to us by Gettess and their Trade Navigator software, which I use regularly. Looking at a weekly bond market here, you can see last week we weren't sure if the Keltner channel signal was going to override, and it certainly has. And to review, that is when you have a trend strong enough to break below Keltner, the bottom Keltner, and it rallies back up to the midline, that usually is time for it to take a pop back down. Now that pop could be to test this low, it could be to test this Keltner channel here, or it could be to take another leg down. What we have here is also interesting for multiple signals because you have an exhaustion bar last week. Now, exhaustion bars, when they come after a little uptrend like this, if that's going to get reversed, they usually get reversed very quickly. It's just one bar down and then they continue the trend. That's possible that could still happen, but it seems a little less likely, particularly since this was breaking down out of an inside bar. And this week we would be looking for the best resistance to come in the 144.08 area, and clearly they haven't come anywhere near that so far. Of course, support's down right 141.28. And they're not there either, but that looks a bit more likely at this point. And of course, this previous low here is 141.13, and going to test that certainly makes some sense also. So the big risk here is going to be if this lack of ability to get to resistance is showing so much weakness that they're actually going to just take out this low. And man, if this leg's down equals this previous leg down, they could be down in the 135 area pretty quickly here. Of course, with the Fed wanting to raise interest rates, which move opposite of bonds, that's possible. But we'll be interested to see if we can set up another exhaustion bar this week. If they break hard enough to do that, they might at least pause for a while. But for now, they could turn back around, but they're kind of looking kind of weak. Stocks, they're not looking like anything. And this is kind of fascinating to me. I mean, Tuesday was down 36 points in the S&P, which is huge. But you look at it on a weekly chart here and it means nothing. This is all just one big, long 11, 12-week sideways pattern since early February. And we can look at resistance in the 2960 area here. Support could have been 2645, probably is closer to 2600 down here. But all of that kind of doesn't matter. It's all just sort of in the middle here. And until they break out of this pattern, either to the downside or the upside above these highs here, it really doesn't mean anything. It's just one big mess, and a mess with a lot of volatility. So we're not really choosing a direction here, and that's unfortunately could go on for a while. And the reason I say that is this move up here that ended in January, that's what, 14 months old? Yeah, that's a good 14 months old. When you've trended hard for that long, they have to consolidate it in some fashion, and so a prolonged period of sideways here wouldn't be a big surprise. Now, I can't predict that. No idea how long a sideways pattern would last, and I will say this momentum indicator down here shows no positive at all. The RSI is staying below the moving average for the entire move, which, it's not a high probability, but it suggests a downside break is a little more likely. Of course, they don't have to turn back up very hard. Probably just taking out this high would turn this indicator positive. So, it's not the end of the world there, but it is an indication that things aren't that wonderful. But not wonderful at this point just means sideways. So that's what we've got for you today. I hope you can find something